Well, we got the breakout we were looking for on Friday. We talked Friday before the weekend that if we can get above 275, 2750 on the S&P 500, that would be a great thing. I even tweeted out this morning, if we got a little bit more of a range, I feel even better about that. So we got that. So what does that mean now? What do we expect going forward the rest of this week and the rest of this near-term run, as well as this intermediate run that we're starting? You know, does that alter the expectations that we had last week where we were looking for more of a pullback? So I'm going to break all that down as well as look for an idea today within a sector that's been really lagging, not as famously as these interest rate sensitive areas, but is starting to show some signs of relative strength coming back. So let's go ahead and get started. Today is Monday, February the 26th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Glad you found us. Keep coming back day after day for more. In fact, subscribe to our YouTube channel by clicking that red subscribe button right down below the video. You can do that right now while you're watching. Also, while you're down there, click the thumbs up icon. That lets me know two things. One, it lets me know that you liked the video, you got something out of it. And number two, it lets me know you want me to do it again tomorrow. So one click, very easy way to let us know what you're thinking there. Comment on anything that stands out to you from today's video. You can do that. Hit scroll further down below to find the comment section down there. Also, remember to join my daily email list where I send out a Market Outlook email every day in conjunction with these videos with time-stamped hyperlink summaries of everything we talked about, as well as a list of all the oversold and overbought clusters in the S&P 500. So make sure you sign up to get that email. Follow me on Twitter for more content in addition to these videos. You see my handle on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned at the top of my timeline there, and then you can see what else we've got to offer. And then finally, join the community, the Market Outlook community on Facebook. You see the address at the top. There's also a link in the description that I've highlighted down below that will take you there. All right, well, let's take a look at the S&P 500 with the market forecast indicator, and you can see that near-term line spiking up into the upper reversal zone today. So a good sign. You know, we looked for the breakout above 2750, we got it. Even early this morning, we had a little bit of a range, and that's what I tweeted out. And again, make sure you're following me on Twitter if you're not on already. I tweeted this out early this morning that we were just getting above that breakout level, but to really solidify that, we need a bigger range, and you can see how we were pulling back to the gap that we had. Well, we bounced off that low point and rallied higher, and didn't quite get the volume I was looking for, but at least got a much bigger range. We'll take a look at that in a second. Again, make sure you follow. There'll be go to David. Here's the address, the web address right there, twitter.com/DavidSettle42. There'll be a follow button right there. Click on that button. And make sure you're liking and retweeting my stuff. That way Twitter knows to Twitter won't show you everybody you follow, all their stuff. So just because it'd be so much, you know, I follow 2,000 accounts. They can't show me everything from everybody, but they show me everybody that I engage with the most. So make sure that you like and retweet, especially this, the Market Outlook tweet at the top. The more you do that, the more they'll keep pushing you, the Market Outlook tweets especially. And the benefit, again, I get out of that is the more you do that, the more Twitter will push this out to all my followers, even the ones who aren't liking or retweeting, just to make sure that they're seeing it. And then for anybody else that likes this kind of content, you know, with these cash tags and keywords and all that in it, they'll push it out to them as well. So I get a big benefit out of it, you get a benefit out of it, and you get more content in addition to these videos if you keep following me, if you follow me on Twitter. Even if you're not a Twitter person, it's still a good thing to do. Still a really, really good thing to do. All right. But you see the momentum line, which had spiked up to an extreme high Friday, pulled back a little bit, but that doesn't matter, right? It hit that extreme high. We weren't really looking for a trend change because we were already bullish, just not very strongly bullish. Well, now the intermediate line is nice and solidly in the upper half. Well, I guess it's not quite solid, but much better than it was last week. Market sentiment even looks like it might be forming a bottom here and rounding out. Now, again, it takes a while for it to round out a bottom. You can see over here it took, you know, what, a month to round out a bottom. But in that month, the S&P rallied up to new all-time highs. Are we going to get up to new all-time highs here? I'm not quite sure because of how volatile the January was and then how volatile the first couple of weeks of February were. But, you know, again, this line right here is a 23% pace. Is pace for a 23% annual return. And again, that number comes from Ryan Dietrich, who tweeted out that you get when you have a 5% move or higher in January, which is up to right there. When you have a 5% move or higher in January, in this case we had, what did we end up having? From that close up to right there, 5.6% move. So 5% move or higher in January, you get an average return of 23% in those years total. So you can see that's what that line represents. I mean, you can see we're back above it. Just like that. I mean, we were so far above it beforehand. There's no way. I mean, we were on pace here for an annualized return of 155%. That was not going to happen. And of course, by then, we were on pace for a 27% loss. Most likely not going to happen either. But now we're back on that pace. We've come off, it's just like that linear regression trend line, right? We get above it, we revert to the mean, we get way below it, we revert to the mean, and now we're back on that mean. Now, we're going to end up with a 23% return. Who knows, right? Who knows? That's just an average. Obviously, there's years where we've had bigger than that, and there's years we've had less than that. And which side of the coin we're going to be this year, we don't know. But this kind of gives us an idea. As long as we're above it, we're on pace. If we're below it, then we're not on pace. And you can draw a new line to kind of get an idea. And in this case, you can see now we're on pace for a 27% return. Second number from the right over there. So a pretty decent move and a nice little breakout move that we had. And obviously getting above the 6-week moving average there. Take a look at the Dow Jones Industrial Average. And we can see, same very strong near-term line. So nice, good bullish near-term move. We're obviously already up to higher near-term highs. You can see on the NASDAQ Composite, same thing, extreme high, breakout above that high point of that long upper shadow, and then finally Russell 2000, same thing, breaking above the long upper shadow. Not as big of a breakout move, but enough to get the near-term line at least above 80. Still the possibility of near-term divergence, whereas really no near-term divergence on the others because you got to 100. I mean, the other lines, all got to as high as a level as you can possibly get. So again, is this near-term line going to get us a new all-time highs? Probably not. It's probably not going to be as big as this move because volatility was much higher. The VIX was much higher coming off that low point than it was coming off of this low point. So different scenarios, but you can see the trend is taking shape again. And, all this hubbub there was about bear market potential and corrections and all that, and yeah, that was a pretty decent drop. But again, that was a pretty decent drop only because, and go back to the S&P 500 here, only because the move that preceded it was so big. This move was 3 months bigger than it should have been. And because of that, you're going to get a bigger decline. That's just the nature of inhaling and exhaling, right? You can't take a humongous, way bigger than normal inhale with only little exhales. But, before you know it, you pass out, right? And that's what the market did. It passed out, and now it's kind of getting back on pace again. When you look at the long-term chart, again, we're right back above the 50-day moving average too. And remember, the 50 and the 200-day moving averages are still rising. So those are long-term moving averages that obviously the 50 is still well above the 200. In fact, that the MACD or the gap between the two is getting bigger this week so far than it was last week. So, and you can see here how we climbed above those highs. So far, a good start to the week. We might pull back down. Make a little bit of a return move, but if we do back down to 2750, there will be some support there. So that's a good thing, and like I said, today's range really helps solidify that breakout. We're back to 3 green arrows, so there's the 1, 2, 3 on the sideways trend. Now what we don't have is that big spike in volume, and you'll see here in a second on SPY, we're not getting that. So we didn't quite get. I would have liked to see more volume. We didn't have to see the 1.5 times. I would have been happy with at least average volume because of how high the average is. But we didn't quite get that nice solid volume. That's why I don't think we pushed through to new all-time highs on this one. We might get a little bit above this line here, maybe get up into this 28-25 area, and then pull back down. Because again, same principle as back here. You can't go up every day with only small little exhales. That's not healthy, and eventually you run out of air. Whether it's on a longer intermediate term basis or in this case on a more near term basis. I mean, all we got was about a 23% Fibonacci retracement, and that's it. That's not very much. The 2 lines, you can see the MACD has crossed above 0, so that's a good positive sign. Then what it means is when that MACD line itself, the black line, crosses above 0, that means that the 8-day has crossed above the 17. So good sign for the markets there. The next step of the trend is first you got to get above the 8, then you got to get above the 17, then the 8's got to get above the 17, right? And you can see we're kind of fiddling around there, but finally now we've broken out. The 8's got above the 17. Now you need both those lines to get above the 30. You can see how it kind of does that here. After a little bit of a breakout, you finally get both lines. You might get a little return move afterwards before it really takes off again. But that's the phases to how trends start. If I were to go back out to when we were a little bit further below the moving average, you can see again here, you get above the 8, you get above the 17, the 8 gets above the 17, and they both get above. You get a little bit of weakness, and the trend rises. We've seen that lots and lots of times before. In this case, back in July of 16, it only lasted a month, a couple of months, and that's kind of what I expect here, simply only because market sentiment's already very high. And I know it was already very high back here, but like I said, this is probably where that peak, we should have had a new intermediate low point probably in this area. And we didn't, because the tax reform bill came out and pushed us up higher and higher and higher without that adequate exhale to sustain it. And again, ran out of air, and we don't want to see that again on a near-term basis. And as of right now, it kind of looks like that's what we're getting, because we didn't get enough of an exhale here to really say, okay, let's start a new, solid trend where we're not going to run out of gas, or run out or air. I'm mixing my metaphors there. So now we look at the intraday chart, and you can see we gapped up early, all the way up to 267.5, so 2 points higher, and then pulled back down a point, finding some support in there, not quite filling in the entire gap. And there's some support from back here. See, we got up here at 275 and a third as a high point over there, and that's about where the low point ended up, 275 and a quarter. So that's where it found some support on the intraday basis. We hit it and we moved, and that's about when I sent out that tweet. I would like to have seen more of a range, and we got that because we went up at 2 points off of that. So we had, a range of about 2 points, almost 3 points, but you have to add in the gap, right? So we hit a high at 274.70, the low at 275.26, about another half a point. So when you add on that half a point, then we ended up with about a 3.25 point range. And that's what I remember how I said Friday, about 3 to 4 points would have been nice. Now, we didn't quite get the volume. It would have been nice if we'd have been at, about this kind of volume right here, where we had a little bit of a breakout there above 270. That's the kind of volume right there I would have liked to see today. So, look for a potential return move in the near term this week, back down to 275. And if we break below it, don't be surprised, because we didn't quite get that double punch of good range and solid volume to keep us up where we're at right now. If you take a look at here, so not that one, this one, there's where that 3.5 or 3.25 point range. So it's below average, but still relatively high, and that's okay. You just didn't want it to be too extremely low. Eventually, it will. Now that we've broken through that, it will kind of get down into this area until we test this high right here. And we'll need another decent move to get above that high, 285, because of how bearish that that Harami pattern is right there. The volume, like I said, at 85 million was way down here, so it would have been nicer, even at 125 to 150 would have been more preferred. Again, not too bearish, not too extreme, but enough to say, okay, that's a good solid bust through that 275 level. So it was a good move, but not supported by a lot of buying in this particular case. And that's really been a common theme the last few days is, this big move off of 270 up to almost 280 hasn't been a whole lot of buying behind all of that. Obviously more buying than selling, that's why we're moving, but not with the same amount of volumes that we've seen when we had the volume pushing down to the downside. And you'll never have that, but when you're getting through important levels, we shouldn't have extremely low volume either. Like I said before on volatility, when we came off that low point, we were coming off of 40 off that original bullish move, that bullish near-term move. This one's coming off of 20, so half of what that volatility was. So that's why, again, you don't expect such a big move as we got a week ago or 2 weeks ago. But still, volatility is still relatively high. It's higher, at 1580. You can see, if I go back a year, it's still higher than it was most of the past year. One time it got up to a whopping 16 on a closing basis before closing down to 15.5. over here it got up to 15.5, and over here it got up to almost 16 before falling all 3 times, falling sharply down as soon as we did get to 15. So again, 15 will act as a support level for volatility. And again, support and resistance on volatility is not quite the same because people don't trade the charts nearly as much here. This is derived value from what's happening with the options contracts on SPX. So technical analysis doesn't quite have the same psychological impact, but still, it's still a chart and it's still got price action, so you can still look at it and be aware of it. And like I said before, in the past, 15 was a level where the volatility dropped sharply. We busted right on through that over here. We hit it again at the end of January before falling down a couple of points, and then busted right on through that the first trading day in February, and then away we went, all the way up to 40 in a matter of a day or two. So we are pulling back down. This was a big range for volatility, this particular options expiration cycle. So we'll see if that continues. If we hit that for some support and get some volatility coming again. It would have been nice to have gotten some volatility, maybe up here on that pullback to get up to 25. That would have been a little bit more healthy, like we talked about, but we didn't. And so, we'll see. We're continuing to move higher on the markets every day. That pulls volatility down, and then we'll see what happens with it at 15. You expect support to hold until it doesn't. So we'll expect it to hit 15 and hold for a while until it busts on through. And if it busts on through, your next layer is going to be the top end of this really bullish period for stocks at around 12.5. On a relative basis, you can see, we're still kind of in that neutral area. As much as we moved up today in stocks, volatility didn't drop very much, in terms relative to that back month volatility. It's still in that neutral 90 to 95 range. And again, 90%, the low end of that neutral range will act as a support level, just like 15 will act as a support level for the VIX on an absolute basis. And, all right, now let's transition to what's driving the price action here today. And you can see how equities just continue to lead higher, including crude oil. Crude oil is also another asset, one of those riskier asset classes, obviously, that's moving higher too. If we were to come off this low point from last Thursday up until now, so that was pretty much the low point of the pullback, you can see it's the U.S. stock market that's leading. The S&P 500 up 3% off that low, starting with the gap last Friday, and then finishing with the strong move, and then the continued move higher today. You can see emerging markets is kind of the flip side abroad as it is here. So here, U.S. stocks 3%, or large cap stocks 3%, small caps 2% gain. That's not normal for small caps to underperform that much, in this case over a 2-day period of time. It's the opposite abroad. Emerging markets are doing really well with the dollar being relatively weak, flat for the 2-day period, whereas developed markets are up 2%. So that is what you'd expect. You can see crude oil doing well too, and gold being down, well, up a little bit, kind of flat too, along with the U.S. dollar. Those two things kind of move hand to hand. You can see that bond yields are down, and that's, these are this dark blue line right here. This is bond prices, and bond prices started the day pretty strong and then fell throughout the day, but still up on the 2-day period, and that's a lot of the reason why U.S. stocks are doing so well, or all stocks are doing that well, because again, a lot of investors have been kind of spooked by the move that the 10-year note has been making to get up to 3%. This is obviously on a weekly chart. We still got a lot to go this week, but that's what the last few weeks have been looking like. We've been gradually marching higher, getting closer and closer up to 2.95% almost, and then we talked about how getting to 3% would kind of push us back down eventually to 2.6 and a little bit longer. It takes longer to pull down here than it does to spike up lately. So we've had the spike up, the gap is high, we got the divergence. We're probably going to grind our way now towards 2.6, and that will help. A move like that will get us towards that year-end 20% plus move in equities. But if we bust through 3% and move up even higher and higher, and it's not like we haven't been there before, right? We were 3% we hit at the end of 2013. 2013, you remember, was QE3. So we started 2013 with yields down below 1.75%. QE3 helped stabilize things. We didn't enter into another recession, and then finally, by the end of 2013, we went from 1.75 to 3%. So, it's not the end of the world. 2014 went up. It didn't go up as much, that stock market, and it was really flat in 2015. But you can see it wasn't the end of the world when we hit 3% before. And you can see how we pulled all the way back down below 1.5% by the time we got to mid-2016. Of course, the election comes around, new fiscal policies and expected fiscal policies coming out, and we go from 1.75 again, like we did back here, all the way back up to 3% again. And you can see last time we kind of grind our way back down to 2.5%, and something like that is expected if that 3% holds towards 2.5% the rest of the year. But you can see during QE, right before QE2, or Operation Twist, excuse me, right after QE2, which was embarked upon right here, yields went from 2.5% at a low point up to 3.75%, so much higher than where we were. And then of course QE1 got us from below, between about 2 1/8 all the way up to 4% by the time the beginning of 2010 came around. So that's a pretty decent run. All these QE policies, QE1, QE2, QE3 right here, and then now your fiscal policies, the fiscal versions of quantitative easing that are helping push yields higher and helping lift stock market. So getting too high, though, you can see, that's the concern, and pulling back over the last couple of days has really helped things from a stock market perspective, helped give us that bounce. You can see it's pulled back down to its 17-day moving average, and you can see its MACD is dropping. This is on the 10-year note, right? The stochastics is dropping from extremely high levels, and there's your 2.5% level, which in this case, we never did get up to 3%. So we'll have to move this down. If that ends up being the high point right there, then you're looking at, these highs right about 2.6. That's where there could be some support here in the near term, and the move back down there will help lift the mood a little bit on Wall Street and help keep stocks afloat. If we hit the 17-day though and bounce off of it, because again, that's the first, when you're changing trends, the first thing is to test the 8-day and then test the 17-day. Getting below that now will be something, but so far we're holding it. If we were to bounce off of this and continue this trend, and we've seen MACDs when it comes from high levels, you kind of come back up above it, hit the moving average, maybe get a little above it, form a lower high. So we can bounce off of this, and that's what could create higher volatility for stocks, and eventually more of that exhale that we've been looking for over the last week or two. If you take a look how all the sectors are performing, again, this is from that low point on Thursday through Friday, and then today, utilities started off the week strong. Again, the yields have been pulling back, right? And so they've been doing really well. Real estate hasn't been doing as well. Still up over 2%. Hasn't been doing as well because real estate, news we're seeing in the real estate markets with higher mortgage rates and lower affordability is really impacting that sector. So it's kind of this interest rate sensitive sector like utilities isn't being helped as much because of other factors. But utilities definitely started off today really strong before pulling back to 2.5% gain for the day. You can see if I just look at today only, it was an underperformer, but not at the beginning. Real estate, and there's your consumer staples, materials and energy lagging behind. The dollar has been flat over this 2-day period, right? So not really helping those sectors as much. Technology, industrials, there's healthcare. Healthcare has been a sector that's been starting to gain some traction. It's been an underperformer. If I go back to the 4-week period here, there we go. Finally, you can see healthcare here pulling back initially, pulling back down, towards that February low point, and lagging behind a little bit, but starting to pick up. So there may be some opportunity in one of these underperforming sectors, more so than obviously utilities is finally starting to pick up, and real estate a little bit too. But health, while those have really started to take off, healthcare might be offering some opportunity as well. One of the stocks in that area, again, not really an outperforming area, but there's opportunity for it to start catching up, right? More so than, say, some of these really beaten up sectors. So there's some opportunity here. And one of the stocks in that particular sector, Medtronic, From a technical perspective, you can see it had a pretty decent day today on the market forecast. It had been trying to establish a bullish posture coming off that, the deep low point that everybody suffered through. And you can see it did pull back down a little bit more healthy than the broad market did as a whole. That's the kind of move lower. You can see here, there's nothing too earth-shattering, but at least it did get right around to that 50% Fibonacci retracement. Oops, right there. So that would have been more normal. And you can see now today bouncing up off of this higher low point. It would be a higher low point, closing above the high of all these 3 days consecutive last week at the end of the week, bringing the near-term line back above 50, bringing the momentum line back to a higher level. And you can see it doesn't really get this high. It's up to 97. It's been this high once before, and it had a pretty decent run after that for a while, where it kind of bounced off a higher low point there at the beginning of June. So there's opportunity here. Say, okay, well, I don't want to be too aggressively bullish. It is below its moving average. You can see it's crossing a little bit above a downward sloping exponential moving average in between these Bollinger Bands. Now you notice we hit it before, used it for resistance, and then now formed a higher low point. It's not anywhere close to that lower band. So there's opportunity again here for us, for some support to be in this area. So what if I sold an option at 70, sold a put at 80? Go out 53 days, sell that 80, buy the 77.5. I can get a pretty decent credit, pretty decent odds of success, not even looking at the chart. But when you throw that break even on the chart, you can see that the short strike price would be right at a support level. So here's an opportunity, a high probability trade, knowing that if it breaks 80, in this case gets down to about, $79, then I'll lose about $55, no matter when it happens. And that's about a 1-to-1 reward to risk ratio for what I'm looking to do here, with a pretty decent high probability of getting the reward in that ratio. So again, taking advantage of a sector that's beaten up, that's showing some possibilities here of a new bounce. You can see we're getting 2 green arrows here on the MACD, and stochastics coming off a higher low point on both, crossing above their moving averages on both. Not quite getting above 0 on the MACD yet, but again, I'm not aggressively bullish here. We just need this 80 level to hold for support, which is done here multiple times. Even here, the one day we closed down sharply below it, we got right back up above it in a matter of a couple days. So you can see kind of how 80 is an important level. It was an old high point back here, and then it got tested again, dropped below 80, got right back above it up there in early December. And like I said, market forecast suggesting that we might, giving that kind of that red sign, the momentum red, that we are changing to a new trend, in this case from what would be a bearish posture on the intermediate line to a new bullish posture. So that does it for me tonight. Again, thank you very much for watching. It's been quite the interesting market here. It might be a little, we might be running a little too hot on a near-term basis. We might need a little bit more of an exhale. So don't be surprised now that we've broken through 275, which is good. It's a good sign for the intermediate trend that's developing. But don't be surprised if we don't make a return move back down there, if not tomorrow, sometime this week, and establish and kind of solidify that new support level to make a later run, a more solid later run up here after the fact. So, and again, one of the areas that could start leading, that's been lagging, but could start leading that way higher, and we're seeing some signs of relative strength, is in that healthcare sector where we targeted for our trade idea today. So again, thanks for watching. I hope you all have a great evening. Brandon will be back on tomorrow, so stay tuned for him. Remember to like, subscribe, and comment down below on the YouTube channel. Follow me on Twitter for more content, as well as Brandon and our Market Scholars account. And finally, join the Market Outlook community on Facebook with the link down in the description below. That's it, everybody. Have a great evening, and we'll see you all next time.